Hello. Today I quickly want to go over a topic that keeps coming up in my conversations about bonds. Namely, what happens if interest rates go up and you're a long-term bondholder. So the chart we're looking at here shows, the title says all long-term bond returns are driven more by starting yield than interest rate moves. So in this scenario, we're looking at a hypothetical 4% interest rate bond with a 5-year duration and then a 10-year timeline. So essentially, you own one 5-year bond, and then at the end of the 5 years, you have to buy another 5-year bond. This resembles what most of my clients do. They're retirees. They're not day trading bonds. They're holding bonds as a long-term important part of their portfolio. So in the scenario we're in today, if you were to own a bond that had a 4% yield and interest rates go up to 5%, immediately it looks like your portfolio has gone down in value. And so people look at that and go, oh my God, my bonds are getting crushed. Why would I own this bond? Well, the reality is, if you own that bond over that 5 years, you're going to get your 4%. And we would actually like to see higher interest rates because as that cash flow comes off, we're reinvesting it at higher and higher rates. So in this scenario, we're looking at this yellow bar represents what happens if interest rates stay flat for 10 years. Well, in that case, you'd end up with a 4% return. You take your 5-year bond paying 4%, it rolls over, you buy another bond that pays 4%, and your total return over that time is 4%. On the other hand, if interest rates go up by 4% for 10 years, that means you start at 4%, the next year you're at 4.4, then 4.8, then 5.2, etc. You end up with a cumulative yield over time of 10 years at 4.2%. On the other hand, if interest rates go down by 0.4% per year, so you start at 4%, then you're at 3.6, 3.2, etc., after 10 years, your combined yield for all 10 years is an annualized return of 3.8%. So in other words, the short-term returns that you see in your bond portfolio, interest rates go up, your values go down. In the near term, it looks like we don't want interest rates to go up. But as a long-term holder of bonds, interest rates going up over time tend to benefit our portfolios because they increase the yield that we can expect to see over time. Again, the reason is because as our interest and principal comes due, it's getting reinvested at higher rates. If interest rates go down, it makes us feel good in the short term because we see our values go up very quickly, but in the long term, it means lower yields. So again, I just wanted to bring this to your attention. And if you have any questions about this or anything else, just let us know. Thanks. Have a great day.